Hey everyone, so we're continuing with the marathon. Again, all these videos are being filmed pretty late at night, and I'm able to do this because Tuesday is actually a good day for me. I don't really have much work, so I get to sleep in. A little bit blessed in my next work. I won't be able to do such things anymore, sadly. But the flexibility is much welcome. So taking a look at UNM today. UNM's a position within the portfolio, and you guys might be familiar with it at this point because you might go into the public portfolio and you might be seeing it and you're like, oh, what is that company? I've never heard of it. Well, that's an insurance company, and you might notice that it's been doing really well. I have two insurance companies at the present moment, and that is Markel and UNM, and they're very different from one another. One is more exposed to the bond market. The other one's more exposed to, fixed income securities. The other one's more exposed to, I guess, both, because it still does have fixed income securities, but it's more focused, or not more, I keep saying more, but privately owned companies and publicly owned companies. So what is UNM? All right, so UNM's a stock that we bought, and you can see the average cost basis. It was very distressed, okay? Very distressed when it was added to the portfolio. I was looking at it when, you were in the midst of the pandemic, everyone thinking the pandemic was extremely deadly, humanity was going to die, blah, 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 blah. And that's why I've been kind of avoiding making this specific video. But it's a case study as to taking advantage of fear when fear becomes irrational. And I think at the time, if I had made this video a year or two ago, it would have been very controversial. There is a video where I avoided talking about any of this, and that is I think the only video going over UNM in the Capital Mindset channel. And I'll kind of show you guys here. It was posted October 8th, 2021. And so can insurance companies actually be exciting? Well, let me tell you, they really can't. It's very difficult. Markel does it. Markel, we don't call it insurance company. We say like, oh, it's mini Berkshire Hathaway, Oh, that's far more exciting when I say it that way. Who cares about like UNM, okay, UNM, cool. The only thing exciting about it is its gains. So if you guys take a look at the portfolio, which I'll pull up now, yeah, you can kind of see it there. Where's UNM? Oh, there's someone watching the portfolio. There's always someone watching in the portfolio. Where you at, UNM? Where you at? There you go. I'm blind. We're almost up to 100% gain on this. So very, very proud, very happy with how the performance has been thus far. And I think, this video is going to be an update to see, is it time to start the selling process? Now, my cost basis, or my yield on cost, is actually very exciting. It's very high. So I think it's actually closer approaching to the 10% mark around there. But that's not the point. I don't really care about that. Why did I buy UNM when I bought UNM? Okay, so I bought UNM because at the time, and we'll actually see around where I bought it, we got to go almost a 5 year now. That's how crazy time flies by. 5 years. So it was around this region of time period when I started accumulating UNM. And so even I think some shares were bought around here. So if I'm being honest, it's like this whole time period was when, not exactly on the proper downturn, but around here is when I started buying UNM and building that position to where it is now. And you can see the average cost basis. We'll get to the model, but average cost, where did I put you? Here you go. Average cost basis of about 18.37. So very happy with my cost basis. Don't want to ruin it. Don't want to add any more. But we're holding the position right now. So why did I buy UNM? The question, okay. Well, I didn't believe at the time, based on the information that was publicly available, and this was publicly available information. I believe it was publicly available. It was pretty obvious at the time. And it was very controversial to be saying at that time. But I didn't believe that the pandemic was, so deteriorating to the business, even though UNM executives were saying so. And so I believe that the numbers in a couple years' time would show otherwise. Now, for a while, they were writing things off. UNM's executive board or executive team was taking the precautions, doing what they said. And so I was building my position, and I believed that the instances in which they were stating, this thing's going to perhaps be a massive risk to us, and how the investor base was also treating it, that this was going to be a massive risk to them, I believed it was not going to be. And turns out, as of more recently, the earnings are actually showing that. And now we saw this massive pop more recently. I'll show you guys here. So you can see the pop that happened in a single day. Basically, to summarize, earnings were pretty good. They reported earnings and showed a book value increase. And book value increase for an insurance company is really telling as to what's really going on in terms of the risk profile of their liabilities, the value of their assets. All these things are doing well. And you might notice, or you remember the videos in which I was always discussing with you guys that the rising interest rate environment was not beneficial to the banks. Okay. Now, remember what stocks did I sell in 2021, tail end of 2021? Oh, that's right, the banks. Now, what was my whole thing also around that time period, also in January, December, and a little bit of November? The liquidity crunch thing, remember that word? Okay, so what was kind of like the cause or premise behind the liquidity crunch? Well, let's ignore like the broadest parts, but one key aspect was the Fed threatening, rising interest rates. And even if you're Snyder-pilled or not, like I always say, even if you're Snyder-pilled, you still believe that the Fed can control psychology, which does have an effect on rates. But okay, so rates go up. Why would I not want to own banks? Why would I get out of my banks and only keep Citigroup, by the way? But you guys know why I kept Citigroup. Well, because banks make money on the spread, and insurance companies, they are taking that premium money and they're buying those fixed income securities, and they're generating more income on that income. Okay, that float can generate more income. So in a rising rate environment, we can go through some insurance companies right now, but Unum's one of them. Unum's benefiting from this. Here's another one. Here's Cigna. So Cigna's a larger one, $83 billion one. You can see that they're kind of having a similar positive reaction during the same time where this liquidity crunch has been occurring. When rates were rising, their stock price is rising as well. There's a bit of a correlation between that, and it makes more sense when you kind of break down what these businesses are applying their float to. So, well, not all businesses have floats, but the insurance companies, where are they putting their float? They're putting it in there. So let's take a look at some other ones. Here's Allstate. Allstate, this one's a car insurer, or, they actually do a bunch of things, but you probably know them for their car insurance. Allstate, are you in good hands? That one. You see that successful marketing? Look at that same time period during that supposed liquidity crunch we went through, up about 20.38% because they do well. Now, let's actually pick up a bank. So let's actually pick BAC. So my favorite bank, Bank of America. So let's look at the 1 year. Boom, you see that mirroring right there. So that was a good move, and we were talking about that again. There was even that video in January where I stated my moves, right, in terms of selling the banks, and even a little bit after that, I think here in February we still reached another high before we kind of saw the manifestation of what is we were talking about. Now let's actually talk about that a little bit further. Well, okay, so if we see this, supposed liquidity crunch, let's get a little bit deeper than that. Not only is it about rates, but it's also about liquidity itself. We talked about it when we were reacting to the Popular Investors videos, that he's actually kind of discovering it himself as well recently. So I feel happy and vindicated in that sense. But regardless, looking at something like Bank of America, Wells Fargo's earnings report was really indicative. If you read those actually give you a good insight into kind of the health of the consumer, the health in terms of the lending market. Wells Fargo has a massive balance sheet with mortgages, and we're seeing some lending growth decline there. Part of the liquidity crunch there, guys. So something like an insurance company doesn't necessarily care about, but sticking back to Unum, turns out liabilities weren't as bad, in summary, and the premiums were pretty good. Book value went up, earnings were pretty good, beating expectations. But the biggest key is going back to the liabilities of the pandemic were not as bad as what the market was pricing in at the beginning of the pandemic. So to remember, Unum, you can see why did it fall so severely? Because they actually insure companies for their employees falling ill and dying or not being able to work. And so if you had believed that, this was the Spanish flu, Unum would have gone BK, okay? But if you didn't believe that, and if you actually believed that the numbers were not as bad as what was being reported back then, or better yet, that the virus would actually mature and eventually not, either perspective was correct, right? From this point of investing, either perspective, had you invested, you would have done very well for yourself and actually outperformed what the market was going to return to you over that same time period. So you're seeing right now that you're holding Unum, you're pretty happy. You're holding these insurance companies, not all of them, but you're holding some of the insurance companies. You're pretty happy. Okay, you're not doing too bad for yourself. So, and not only that, you did actually get to secure a decent yield at the time. Now the yield's kind of more tamed at a modest 3.3%. You know, you're not gonna retire off of that, but all right. So let's actually head over to the model and actually get an idea for what this is. This is, going off of that Wayfair video we did, but taking a look, let's actually plug in UNM, see what it comes up. We'll take a look at the analyst estimation, see what they say. Of course, they say it's a buy now, but with the price target of 25, it implies a 30.06% downside. Okay, so these growth rates, ignore them because these are overly optimistic for something like UNM. Now, UNM is a chronic buy backer of their own shares. So I do believe they will continue to buy back their own shares. And taking a look at where we are today, the max buybacks they're capable of is very drastic. Okay, I don't think they will do that because they want to keep it close. Now take a look at that Altman Z-score and the company's own, not the company's own, the model's own measure, is that it does imply they have a decent bit of leverage, okay? And I'll explain why. It's because it's an insurance company, so we don't want to actually pay too much attention to these two metrics at the present moment because they're taking into consideration a bunch of things that we might not want to care too much about, and that has to do with like the size of their liabilities relative to the size of the company. The model's actually freaking out about that and saying, whoa. It's like, okay, well, calm down. There's a little bit more nuance to that. Okay, so the market cap is about 7.3 billion. I believe the float of the company in terms of not liabilities but assets is about in the 50s, somewhere around there, 50 something billion. So that's the portfolio size. So taking a look at the revenue is expected to actually decline slightly, and despite everything, the cash flows are expected to actually rise or continue to rise a little bit here, and the shares outstanding you can see have declined drastically. So we are going to have to actually treat this, by the way, if you remember watching the insurance video, we're going to have to do the adjusted cash flow measure, and from there we're gonna have to do that. So very important that we do that, and we treat it like a financial institution. Now I do have to relabel that because that shouldn't actually be labeled financial institution because it also can do other things, and so it adapts itself depending upon what it is type of company that I put in. So, but I still have it named because I'm kind of lazy, to be honest. It takes me like 5 minutes, but whatever. So anyways, I don't think they're going to grow at this rate. This is actually more of an anomaly based on what happened recently. So they're kind of in the recovery mode. I have it so that on the high end, they can grow at about 15-ish%. And so that would imply fair value of about $58. And so that's on the high end. Okay, let me be very clear. And then 10% on that front. And then this one was around 12-ish%. And then on the lower ends, I do think that there's a possibility for a small decay over a long period of time. And you can see that for my price point, I can actually be okay with that. Okay, I can actually be okay with that. I'm already in that in terms of price. So I'm happy where I'm at in terms of where I own this company. And then taking a look at a smaller, modest one, about 5%, you see we're not that far from that one. Okay, which is really interesting. Now, you might say, well, you're being too aggressive with these buybacks. Sure, let's actually see what the 0% bound is. You can see that my price point is around that -2%. So I can actually assume some decay because that's the price you get in. So price of what you pay for an asset actually will have a hand in showcasing what risk you have in terms of that investment. Okay, because if you pay for something at a lower price, you have inherently a lower risk to a degree, because obviously everything can just go bankrupt. But those are kind of my thoughts on UNM. I do like the company. I'm going to be keeping the company. I'm not going to be selling it right now. I like the price that I purchased it for. If it gets too much past that 12 to 15%, that's when I'll actually start to consider liquidating my shares and taking my profits and then kind of redeploying it elsewhere. Of course, I'm very excited to add to my other positions, such as Meta, such as Netflix, and those positions I'm still trying to build up. I haven't really added any meaningful positions or shares to Netflix more recently, but I will do so in an update video at some point, and then when I'll do that, I'll let you guys know. So on that note, guys, thank you guys so much for watching, and if you guys like this video, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe, and yeah, I'll see you guys in the next one. Bye.